Good morning and welcome this morning to the final episode of Trader Talks in today's market for 2025. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. There is the opening bell, which means that the final day of trading for 2025 is off and running, which answers the question, Brent Moores, who's my guest today, is the market open on New Year's Eve? And the answer to that question is absolutely yes. It is a tradition that it is a full trading day on the last day of the year. So welcome, Brent Moores. Glad to have you here with me this morning and with us. We've got a bunch of great folks here. How is your 2025, Brent?
It was quick, Ben. You know, it's the old thing that your parents always told you how fast life speeds up as you get older. Well, it's true. I can vouch for that. So it was a good 2025 year, though, Ben, and I'm glad to be finish off with you today.
Absolutely. And by the way, we've got our good friend Barb Armstrong, 20-plus year veteran of the financial markets, out there in the chat helping to answer those questions and be a part of the conversation. So those of you that are joining us, if you've been here before, you know the drill. You know that you can be a part of the conversation. We'd love to have you chat in your questions and your comments, maybe your New Year's resolutions. We'll talk a little bit about that here, the things that you remember from 2025. If you're watching this in the recorded version, well, thank you for being with us this year as well. You can be a part of that conversation by leaving your comments in the chat as well, or in the comment section. So a couple of quick housekeeping items, Brent, that we do need to get to this morning before we get started. As the market gets up and running on this final day of trading for 2025, remember that everything that we talk about simply for illustrative and educational purposes only. It is not a recommendation or any kind of advice. If we happen to talk about options in this discussion, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any options strategy. Also, remember, we're going to be using, as we always do, the Paper Money platform from Thinkorswim. That is the Thinkorswim desktop software version. We've got other versions of the Thinkorswim ecosystem out there as well. We'll talk a little bit about some of the other education that we provide along the way. But remember that the Paper Money platform, not a guarantee of future success out there in the real world, and it doesn't do certain things that a live trading account will do. Of course, we're going to use some technical analysis this morning, and technical analysis is only one way to look at the market, along with probability analysis, fundamental analysis. All of those are theoretical. None of those are guarantees. And past performance, whatever has happened in 2025, does not guarantee in any way what is going to happen in 2026. And it's always a good idea to remember that investing involves risk, including the loss of principal. Remember, if we talk about anything that discusses virtual currencies, those involve unique and significant risks. If we talk about futures contracts, remember that those are used for market definition only, and we're not talking about them in the context of tradable instruments. We have an entire class for that, which Brent has taught as well as I do, and we'll talk about those things as we get into this discussion this morning. But Brent, I thought we would start first of all this morning here on this final day of trading, looking at the S&P 500 and the NASDAQ and the Russell 2000 as they sit right now in the course of this 1 year chart that we're looking at. And it seems that, Brent, the last couple of days have been pretty flat going into this last midweek trading day of the year. Since we're on Wednesday, we've got a couple of days left in the week, but only this last trading day in the year, Brent.
Yeah, not much of the Santa Claus rally, so to speak, here, Ben. Not this year. The last couple of years, no, same. And I guess there's still a couple days left. I guess technically they consider it the first couple days of the next year that it would can be considered. So I guess if we had a big enough rally those days, we'd have that. But no, we're just kind of, and today you can see we're down just a smidge. But kind of just flat, waiting for the next year, I think, to come. But hey, that doesn't take anything away from the year's performance. Up, what, 17% this year?
17% this year in the S&P 500. If we flip over to, let me pop back over to my index grid. I'll grab the the broader chart here, we'll take a look at the index grid, which gives us about 16.73% year to date so far, month to date up 0.67%. But on the week, again, like we said, kind of flat, momentum falling off, but not hugely so. Lower volume in the last few days. Traders are human. They go on vacation too.
Yeah,
And
and
spend a little bit of time with their family.
Ben, 17% isn't a bad year, right? I mean,
No, not at all.
I'd love that every year. Looking back at past years, yes, last year it was up more. It was up about 25% last
Yep.
year. The year before, about 26%. The year before that, down about 18%. The year before that, up about 29%. The year before that, up about 18%. So we've had a pretty good streak, with the exception of 2022, of runs above historic averages for that S&P 500. You can see that on the 3-year chart, Ben. I mean, that's a pretty darn good run there. Had a little bit of a hiccup early this year. And a lot of that was news related, tariff,
Sure.
tantrum, whatnot. But all in all, is the more you zoom out on the S&P 500, the better it looks, I guess I would say.
Sure. I'm actually going to take this out, Brent, since we're here. I'm going to take this out about 10 years. So going back to 2015, all the way back to that time frame. And we can see that this trend has continued really since that scope. The last 10 years have been very strong. You mentioned that down year 22 into 23, and we saw that downward movement. But overall, looking at the trend here, if you don't take into account the length of these moving averages, because remember, this is now a 200-week moving average and a 50-week moving average. There never really was a time that 200-week moving average, that longer-term moving average, really backed down. And in fact, we never really had a situation where, other than that 2020 low, the COVID low, in the last 10 years, that we've really had a significant lower low relative to a previous low, Brent, have we?
Yeah, no. And that's, I mean, it's not, it doesn't mean it's going to be that way in the future, but it just means we've been really strong lately. And, some people talk about, well, valuations are high. Well, yeah, valuations, but it depends on how you measure. There's a lot of different ways to measure valuation, market valuation. Sure. But it doesn't mean they can't stay high, because part of the valuation equation, let's just say we take a PE ratio as the most basic valuation equation probably. The denominator in that equation is earnings. And if earnings grow strong, if we have a strong 2026 year's growth in earnings, we can certainly maintain market performance being strong. Now, I don't know what it's going to do, but boy, there's been plenty of times in the past when we've seen pretty high market valuations. I mean, the PE ratio at the end of last year was up about 28 for the S&P 500. Most people would say that's high. A lot of people said it's too high to sustain and the market's going to have a terrible year. Well, you know what? Yep. It continued up. And that goes for individual stocks as well. I mean, there's been plenty of times. Look, if I had $1, Ben, for every time I thought a stock was going to go down because it was too high, I'd be rich, because it's just hard to predict that at times.
It really is, and I think if you put it into that longer term context, right? And we talk a lot, Brent, about the idea that traders are investors and investors are traders, and many of our attendees this morning, many of the attendees in our webcasts across the broad variety of topics that we cover, many of our attendees at our live events that bring in, nearly 1,000 people every time we do an event, have some sort of longer term holdings in addition to shorter term trades. And I think you start to put it into this type of perspective and you say, every time it looks like it's too high, maybe it comes back down a little bit, but that trend is generally higher. I make the comment usually, and I will obviously couch this in disclaimer terms, is that the market generally wants to go higher. That's its purpose, is to grow prices, grow stock prices, because companies generally, with certain nefarious exceptions perhaps, are in business to make money. So if we take a look at the longer term perspective here, in fact, if I were to take this out to the max time frame, we go back 100 years, and we go back into 1925, and with all of the things that were going on back then, obviously the magnitude of movement is compressed because of the time frame here, but you can see the longer term trend of the S&P 500 over the course of that 100-year time frame, Brent, and that really starts. I mean, I don't know that we may have some investors in the chat today, or maybe in some of our workshops, that have been involved in the market for the last 100 years. It's not without precedent, but generally this market has been moving higher over the course of the last 100 years because that is what it is designed to do, regardless of whether the current PE, which is sitting at about 31% versus the long-term historical PE is about 16.9 or so. It is overvalued from that perspective, but it still moves higher.
Yes.
I mean, it can't go down.
There's an adage. This is for longer term. We're talking longer term here right now. And so we're, a lot of times we focus in this webcast on trading, shorter term. But there's an adage for longer term investors that says time in the market is more important than timing the market. Sure. And that goes exactly to what you just showed. The longer term you look, the better the odds are that the market's going to go up. And now, like you said, Ben, you said, there's probably going to be pullbacks. Yeah. You know what? Every year and a half on average, we have a 10% pullback in the market. Every 4 years, we have a 20% pullback in the market. And, you can go on from there. There's going to be pullbacks, but, the longer term charts are, I think, helpful for us as
for sure.
You're allocating your portfolio. And a lot of what we talk is about more active investing, but your portfolio may not be 100% just long-term dedicated investing or 100% shorter-term trading. There's a good chance a lot of you have portions of your portfolio that have both elements in it.
Right. Now, there's an analogy that I use, Brent, and I use it when I'm teaching webcasts, and I use it very often in the live events that we do. And I talk about getting on a bus. And if your intent is to get on a bus that's going north, and yet you're on a bus that has turned around and it's gone south, one of the things to think about, even though that longer term perspective is upward movement, you may, in an individual shorter term time frame, find yourself in a position where that bus is going south, and you're thinking, hoping, praying that every day that bus turns around and goes back north. Well, that's maybe something to think about in terms of getting off of the bus when it's going the direction you don't want it to go, getting back on the bus when it is going in the direction that you do want it to go. And that's where things like technical analysis can be very helpful in looking at these perspectives. And we look at the S&P 500 here over the course of this last year's time frame, and we can see that I've got two different moving averages on here, Brent. I've got a 200-period moving average. That's that green one. So this is a 200-day moving average. The blue line is a 50-period moving average. We had a death cross and a golden cross in about a 3-month time frame there, indicating that period where the price was moving down and then getting back into it. Some investors, you notice though, that death cross and the golden cross both lagging that price movement a little bit. So it's important to pay attention not only to technical indicators, but also price action as it's happening. One of the things that we teach in a number of our webcasts, right, Brent?
Absolutely. So we're going to use technical analysis here, and moving averages can be an integral part of that. Sometimes we'll use moving average crossovers to do that. And people use different moving averages. This is a 50 and a 200 on the chart. Very often we'll use a 20 and a 50, or, for shorter term, whatever. Doesn't really matter. Use what is most helpful to you. Right now, I'm looking at that 50-day, and we've bounced off it quite nicely here for quite a while. We did go below it a little bit, but that seems like a fairly relevant moving average to us right now. But the trends are up on both the intermediate term, I guess is what I'd call that 50, and the longer term, the 200 there.
And I'm going to flip forward here, Brent, to the Nasdaq, the more technology-heavy Nasdaq, the home, if you will, of some of those leaders that we've been talking about, that we hear quite often, not only in the Schwab Network, which is brought to us by our media affiliate, Charles Schwab Media Productions, but also elsewhere. It's out there in social media, and technology has definitely been one of the themes for 2025. Now, one of the things I'm noticing in the chat, and I love this conversation that's going on out there in the chat and asking those questions, the idea that, wow, when is there going to be that pullback? Brent, you mentioned that, every year there's been typically, some kind of pullback. And that's true. I mean, there's oftentimes something that happens, but it's not necessarily something to be fearful of, is it?
No, it's not to be fearful. In fact, it's good, Ben, really, because otherwise we get a big balloon, and that's not what we want. We don't want to have the pop. And so, we're going to have pullbacks. I'm going to repeat the stats I have because a lot of people are asking about those, Ben. And these are stats that I just pulled off the internet, so I haven't personally verified them, but I think they sound in line with what I've said. You get about a 5% pullback every year, essentially, on average. We get about a 10% pullback about every 1.5 years. We get a 20% pullback about every 4 years. We get a 30% pullback about every 10 years. Now we saw that with COVID, right?
Right.
And then, so anyway, those are the stats I have. And it's just, I wouldn't take anything in particular about exactly what the pullback is going to be or what it means it's going to happen at any given time, but it does give you hopefully some sense of maybe it can help you if you're getting overconfident to realize, hey, we've had a good run, because the natural instinct there is to say, hey, we've had a good run. I'm gonna, things are great, and things are gonna continue. The party's gonna last forever. The party doesn't last forever, Ben. Occasionally you have to go home.
You have to manage risk. There's no question about it. And we tend, I think, as traders and as human beings, to be loss averse when things are going against us and risk averse when things are going up. We tend to take trades off when they're winning so that we can book a win and we can be winners. And we tend to leave trades on longer, leave investments on longer when they're going against us so that we don't become, in our own minds, losers. We don't book that loss. But, that's the natural tendency, and we try to work those things out. I wanted to put some things into context, Brent. I wanted to put in those moves that you talked about into context. So I'm going to come up here and I'm going to take this April, kind of March, April pullback here, and I'm going to put that into a percentage context. So that pullback was 24, almost 25%. And that was a pretty substantial pullback, and we saw that, and that was a lot of news-driven movement. But you can see that in the context of the course of the year, that was a small hiccup, and then the market went on to move higher. Now, that doesn't mean that a pullback is going to just stop at one of these levels. If we come back up here and we take a look at this pullback, October into November, into the end of November, we look at that pullback, and that's about 9 or 10%, depending on where you draw that to. So you can see what that looks like in terms of the context of that movement and managing risk. And Barb talks a lot about this. I know you talk a lot about this. I talk about this. There are lots of different ways to manage that risk, whether it's using a stop loss, whether it's position sizing and allocating your portfolio or scaling in and out of positions, whether it's using other instruments perhaps to hedge positions. We teach a lot about that. There are a lot of ways to manage and at least acknowledge that risk, as opposed to just throwing it at the wall and hoping it sticks and then not looking at it or being fearful of it. Be a positive manager of the risk that you have in your portfolio, perhaps, is a better way to look at things, Brent.
Yeah, absolutely. And just to point out, I think you mentioned this. I just wanted to make sure everybody picked up on this. This is the NASDAQ we're looking at. The NASDAQ generally is moving the same direction as the S&P 500 with a higher beta. So it tends to move more when things are going well on the S&P 500. This tends to be doing well. But it does even better when the S&P 500 is going down. This tends to do even worse. So you kind of get usually kind of a similar looking graph, just more of it, basically.
So speaking of that, Brent, I'm going to move over here to small caps. I've got a bunch of lines here on the chart. I'm going to actually clean that up a little bit. I'll just we'll create a new drawing set, and I'll make this really clean. And I'll just take those lines off so that we can see it. But you can see that the small caps, which, as we've started to go into this rate cut cycle, maybe that rate cut cycle is over. Small caps, which were expected to benefit perhaps a little bit more from those rate cuts, have performed the least in the three major indexes. Yeah.
Yeah, I mean, and I was talking about the kind of the correlation between the Nasdaq and the S&P 500. The Russell, the small caps tend to be a little less correlated. Yeah, still there's a positive correlation there, but they tend to be a little less correlated, more rate sensitive, more debt heavy, debt burdened. That makes interest rates more of a key thing with small caps. And so that's what we're seeing here. And so if you ever want to look at that 10-year rate, you can do exactly what Ben just did. He put that /10Y on there as a comparison graph on here so that we can see that. And in general, when rates are dropping, small caps tend to do better. And, you can't overread it, on any few days performance. There may not be much of a correlation there that you see. But in general, as rates ease, you can see this a lot in the April to, October, November timeframe. Rates were lowering. The RUT was doing pretty well. And lately, we've had a little bit more turbulence in both of those areas there too.
Sure. I like that idea of turbulence, Brett. Dagan King answered the question or made a comment here in the chat saying, hey, you know what, those pullbacks, maybe an opportunity to add things to a portfolio, rebalance a portfolio, and ride the wave. So I kind of like that perspective here. Some other questions out there, Brent, in the chat, and I think going along with this as we take a look at, things like the NASDAQ that are technology heavy, we tend as human beings, again, and as traders especially, to get anchored back to things that we have experienced. So if traders have experienced, say, for instance, the dot-com bubble of 1999, into 2000, the Y2K era, and maybe questioning, well, are we seeing something similar here in the AI expansion and build out, and saying, is this real or is this as tenuous and ephemeral as that dot-com bubble was? You got to remember, we're talking about, you see the money that's being spent, and not just the money between the big names within these technology companies that are investing in AI, but also in the halo. And that's where I think maybe you see a little bit of difference from the dot-com bubble of the Y2K era, is that now you're seeing companies that build data centers, that provide energy generation, that dig copper out of the ground, that dig silver out of the ground, those industrial metals that are useful in this AI build out, that those are seeing some actual investment in CapEx spend and seeing some actual progression here. Brent, what do you think about that?
Yeah, I agree with that, Ben. I mean, we are seeing cash flow in a lot of these companies. And if you think about a lot of the bigger AI players out there, they already have positive, strong cash flow. Now, the valuations may be higher because of the AI potential there, but there is maybe a little bit of a difference there in that regard as well. So we'll see, and it's kind of a technology that is going to impact more than one sector, as you mentioned. You mentioned the energy demands and storage, and so that's affecting various stocks across the market.
So Brent, I've got the VIX up. This is the volatility index of the S&P 500, and it's generally an expression of how the options market sees risk in the S&P 500, how they manage risk. So when the S&P 500 is either moving down or there's an anticipation of downward movement, the VIX tends to go up because institutions tend to buy protective instruments. That's how the VIX moves and spikes. It's a reflection of how pricey those protective instruments are. And so this has been a tale of some news over the course of this year. We've seen some VIX spikes that were pretty significant. If we put this into a longer term perspective, we put this into a 3-year weekly. We can even go back to really the carry trade unwind back in August of 24. If we put this into even a longer term, let's go back over the course of the last 10 years, Brent, and take a look at the VIX here. And you can see some of those spikes. Here was the COVID spike in the VIX. But, overall, we look at 2025, and barring this one tariff spike, that VIX has been relatively sedate, maybe staying a little bit higher overall. But what do you read from that in terms of the news of this year, in terms of volatility, Brent?
Well, I think we've come to accept. Look, we had this spike earlier in the year that was, I think, related to a lot of tariff uncertainty and stuff like that. So, and it doesn't mean we haven't had events that have had kind of mini spikes in the VIX along the way. But what we've seen is the market really doesn't like super uncertainty, and it's become more comfortable with lower levels of uncertainty, some things that are sticking around. Look, people still are concerned about tariff uncertainty, perhaps to a certain extent. Well, right now they're going, you just get kind of used to what you've seen and what's been around, and they measure the future potential risk. Now, one thing not to do with the VIX is say, well, the VIX is low, therefore the markets don't see much risk, therefore there's not much risk in the markets. Because the VIX is backward looking in a sense. Like,
yes.
If you look at before COVID or something like that, well, look, the VIX was probably pretty low. I don't remember exactly what was happening right before that, but it spiked after we saw the threat. We spiked after we started to come to the realization with the, full realization with tariffs and whatnot, and these little blips along the way. So just because VIX is low can kind of be maybe a little deceptive if you're new to think, oh, well, the market's doesn't think there's much risk, therefore there's not much risk out there.
Brent, you and I have been working together for better than 2 decades. And I remember back when you and I started working together, there was a conversation that we had, and there was a little bit of a phrase that we would use. And it's a phrase that I don't often use much anymore, but I'm reminded of it in times like this, because it's not necessarily the whole story, but the idea was, and the phrase that we would repeat was, when the VIX is low, it's time to go. When the VIX is high, it's time to buy, because it tends to move in oppositional relationship to the movement of the market. And that isn't always the case. Let me flip over to this one right here, this relationship, and this is the S&P 500 versus the VIX. That doesn't mean that when, to your point, when the VIX is low, that it is a time to exit positions, because price action is the driver, and the VIX can certainly grind even lower. But we are at, over the course of this year, at some historical lows, and we're well below that average. So it bears discussing that may be a time to remain vigilant in terms of risk management in long positions. Yes?
Yeah, I think it's a matter of overconfidence at times. And it, like you said, I don't love the phrase because it can sound too absolute when we say that. But it can be a sign of overconfidence, and just as we've talked about pullbacks today in the markets. Well, pullbacks, you get kind of a sense of complacency sometimes when things are going well.
For sure.
Maybe it's beyond the markets. Maybe it's real life, man. When my life is going pretty well, then, boom, something bad happens. Well, same thing with the markets sometimes, Ben. The markets are going pretty good, then something bad happens. And there's news, there's things we kind of can
Yep.
maybe sort of expect, and there's news that we don't really know, well, I don't know how the earnings is going to turn out or what the economy is going to do. But then there's the stuff that we don't even know is on the horizon. Nobody thought about COVID when that
Sure.
occurred. Nobody talked about collateral debt obligations or anything back in 2005 or whatever. Those are the unknowns, and
Yes.
those are the things that really can jolt the markets.
Well, as much as we'd like to, Brent, as much as we think that we could subscribe to some kind of news service or have some kind of instantaneous information, whether it's social media, whether it's a newsletter, whether it is a website or some other form of delivery of information, the thing about news is news because it happens on an emergent basis, and we can't predict the news. We can't front run the news because the market is going to know it before we are, for sure. By the time it gets disseminated down to us, I don't care what news service you subscribe to or buy, the market is going to know that information beforehand. So if we think about it in that context, I think about it in the phrase that Mr. Incredible from the Pixar movie said. He says, just when we think we've saved the world, it goes and gets itself into trouble again. And I think that's exactly the idea here when we see that everything seems to be nice and serene. That's when something happens and news happens. So be aware of that. News can always happen. We can't predict it, but all we can do is manage our risk. So that's an important consideration here, Brent. I also want to talk about some of those areas as we kind of switch gears here a little bit from the broader market. I want to go over here to my single grid, and we'll pull this up so that we can take a look at some of these specific areas. We've got a bunch of things that we want to talk about, but there are a couple of news stories kind of broadly that I wanted to discuss here. And one of those is what's been going on with energy prices. This is crude oil over the course of the last year. And we can see that crude is down top to bottom about 40% over the course of the year, even though right now it's kind of sitting at the top of this downward channel, if you will. It's up a little bit this morning to the tune of about almost a full percent, 0.75% this morning, continuing to move up into that 50-period moving average. But crude oil, energy prices, without question, have been dropping, Brent.
Absolutely. And that's good news for a lot of the economy. It's good news for all those businesses out there that use energy, which is almost everybody. It's good news for the consumer in that regard. Not so much for oil companies necessarily, but
Right.
it helps the whole inflation narrative right now. And that is a big concern, but it's still a concern. Inflation concerns haven't gone away. The Fed is keenly aware of that. And it's a big factor in monetary policy as well, is oil. So oil's been trending down there, and we get these little fluctuations. And of course,
Sure.
Oil has a way of, if bad stuff happens, say geopolitical stuff happens, oil has a way of spiking quickly, which is different
Sure.
than, it goes opposite a lot of the market. And, because if like war in the Middle East breaks out or something like that, well, the market as a whole may kind of tank. It could. Oil, on the other hand, very likely would spike in that situation. And so, but yeah, the general trend has been down. Fair amount of supply, and the supply, it's oil gets low enough. Extraction prices for oil will kind of limit supply a little bit. So
Sure.
There's kind of a self-correcting mechanism there in that regard. But OPEC's been pretty low oil price friendly right now. And, things that may affect the market sometimes, you may worry about how it's going to affect oil markets like Middle East or even Russia, Ukraine. Right. People are kind of go, well, it's same old, it's not really affecting things that much. We're not going to let it worry us too much.
Absolutely. So taking a look here now at one of the other stories of the year, and that has been the historic and monstrous rise in gold prices. Now we're using the gold futures chart here just as a measurement of the market. But I wanted, Brent, before we get into gold, I wanted to address a particular question that was asked out in the chat. And Koala asks the question, well, hey, if we can't use news to predict what the market is going to do, what about market internals? How do we predict what the market is going to do? And I want to answer this on a philosophical basis, and then I'm going to give you an opportunity to address this as well. And I'm going to say this: we can't. I don't care what internal you look at. I don't care what leading, quote unquote, I'm using air quotes here, what leading indicator you use. You cannot predict what the market is going to do. We can't know with absolute certainty what the market is going to do. So it becomes a matter of probabilities. We look at technical analysis, we look at probability analysis, we even look at fundamental analysis, which is theoretical in nature. None of it can predict what the market is going to do in the next tick, the next hour, the next day, nor the next year. So how do you deal with that? From my perspective and from my seat, you manage risk and you trade the probabilities. Brent, I'll let you take a crack at that one.
It's a good question. It's a tough question there, Ben, but let me say this. There's a lot of brilliant Harvard quants coming out every year. And if there were a market internal that would predict that, even before the advent of AI, it would have figured it out, and then it's a kind of a self-defeating mechanism, because then everybody would just do it. So that would be my take, just from a practical standpoint.
Yep, absolutely, and I appreciate that. Now, taking a look at gold, this has been a substantial mover, and part of this has been kind of that climbing the wall of worry perspective, that gold has taken a traditional role as a quote-unquote safe haven, but safe haven isn't safe necessarily. We're talking about safety in relative terms. Gold could still go down. The other big one, Brent, is this one, /SI.
Oh, yeah.
And this has been something that has been specifically in the last few days, and I talked about it in my futures class yesterday, specifically in the news, and that is silver futures and the price of silver. And more importantly, some of the questions that people are having, because we haven't seen this for a while, the increase in margins on silver futures and silver trading that have people perhaps a little bit unsettled, Brent.
Well, it probably makes sense there. The CME increased margin rates. It's just a matter of they're trying to take into account the potential volatility of the asset. And if an asset is more potentially volatile, then there's more risk, more potential standard deviations, or more potential ups or downs. And we've seen up this year, massive ups this year in the silver futures. But then there's, we kind of deem risk as there's a symmetry to it. If it can go up, it can go down a lot. And in terms of perceived risk. And so the markets are just trying to protect themselves in that regard. And so margins have gone up. So that's probably negatively affected. So, well, we got it down 7% right now today. We saw that a couple days ago as well, because this is the second time of late that we've seen this. But not to take away from the I mean, I don't know what the percentage increase this year is on silver, but I do know it's more than gold even, and gold has had a stellar year.
202% if we go low to high over the course of the year. 202% from the lowest low to the highest high here in silver, and that's a pretty good run in anybody's book, I think, Brent. You look at this. This is, I think, reflective of, to go back to the question that was asked in the chat, is the AI build out real? I think this is an indication of that. The fact that silver, because it has such an integral component of not only power generation from solar panels, batteries, industrial demand, those types of things, that is reflective of that perspective, Brent.
Yeah, and I think going into the year, Ben, the kind of gold, sometimes people look at a gold to silver ratio, And the gold had been kind of overvalued compared to historic measures against silver. Well, we've seen a little bit of a correction in that this year
Yep.
here with silver's outperformance. And I think also with gold and silver, for a lot of years, for a long time, as you mentioned, it's been kind of a safe haven asset,
Sure.
a way of allocating a certain percentage of a portfolio just to lower your correlations or whatever in your portfolio, but to hedge a portfolio or whatever. But people with the performance, it kind of feeds on itself, and people are starting to go, hey, this isn't just like a small little part of a portfolio necessarily. This is something that I'm not just trying to lower my risk with this
Yep.
portion of my portfolio. This is something where we're seeing really meaningful returns here coming out of this.
Yeah, for sure.
And so there's kind of a piling on effect with it. And also, there's more central banks probably buying like gold in particular, but there's kind of this ratio between gold and silver as well that we.
So I had a conversation, Brent, out in my X feed, what formerly was known as Twitter, X, about this run up in silver and in gold, and the question was that I asked also over on LinkedIn was, is there a structural reason for these moves? And this goes to JDML's question: is there a structural reason for these moves, or is this simply demand and FOMO lifting prices by their own bootstraps? And somebody made the comment, well, it's kind of like the tulip bubble. And we always talk about that as kind of the precursor to all of these other bubbles and ideas. But I thought, and I answered the question this way, I said that there is probably a pretty good correlation between industrial demand for silver versus no real industrial other intrinsic value for something like a tulip. It's beautiful, but it didn't really power, the AI revolution the way silver and things like that do. Brent, I know we're running short on time here, so there are a couple of things I want to do really quickly. I want to first of all go back out here and pop into this really quick reminder. For those of you that are asking questions about how do I find information about a particular topic, this is the place to go. YouTube.com, search for Trader Talks Webcasts, and then type in your topic right here on that little search icon, and you're literally going to find dozens of webcasts that talk about a variety of topics, whatever topic you want to get into regarding trading and investing. We've probably covered it in a webcast. We just have one simple ask, and that is this: just click on that subscribe button, give us a follow. It helps you out, it helps other people out. It's a nice way to keep that information flowing. And then if you want to look over the horizon here a little bit, come over to schwab.com/coaching. You've got the full calendar of upcoming webcasts. In fact, if you click into the January timeframe, you're going to see some of the changes in our webcasts that are coming up, and some of the different names and some of the different webcasts that will be occurring next year. And then if you want to join us, Brent, you've been out with us. Barb is a regular on the road with me and with Ray and Scott and Rachel and Kevin Horner and others. But we're going to be in Dallas next week, and then we're going to be in Seattle, and then we're going to be in Sacramento, someplace we haven't been in a number of years. Then we're going to be in San Diego and Atlanta and Denver and all across the country. We've got 23 plus live events scheduled for next year, and this is where you find those as well. Brent, I want to pop back over here really quickly because I want to do a real quick lightning round, Brent.
I did this, looking forward to it.
I wanted to put this together. So I wanted to take a look at the top stocks of the year. We'll take a look at the bottom stocks of the year first. The bottom stock of the year in terms of performance was this one, FISV. This is Fiserv, down about 70% over the course of the year. Also in this space, so this is in the technology space, but also in the consumer space. Deckers Outdoor, one of the worst performers, down 57%. Lululemon, down about 51%. And then this one, Brent, CMG, which was a high flyer, but Chipotle Mexican Grill, down 45%. So discretionary spending and some of these specialty retailers not doing so well over the course of this year. But Brent, let's shift to the other side of this equation. let's take a look at the big names. So I'm going to go from the bottom up here, and some that you might be familiar with. PLTR, Palantir, one of the stronger performers over the year, 148% increase. Newmont Mining, going along with our gold discussion, Newmont Mining up about 184% over the course of the year. And then, Brent, let's look at the top. I'm going to look at the top 4. And I just want to ask really quickly here, the top 4, what do you suppose the top 4 stocks in the performance of the S&P 500 over the course of this last year are, in what particular technology group or industry they might be in? I'm going to pop this up really quickly here, and I'm just going to go from the bottom up. This is STX, Seagate Technologies. That's number 4. Number 3 in terms of production and performance, Micron Technologies up 235%. Western Digital, that is up 303%. And the top stock over the course of this year, at least as far as I understand, this is one, and this is maybe proof of the fact that AI build out, because this is a part and parcel of that AI build out is real, and that is SNDK, SanDisk, with 594% increase over the course of this year.
Wow.
That is the top performer for 2025, Brent.
Some storage devices, peripheral flash memory devices, stuff like that. Yeah.
Yep, absolutely. So, Brent, thank you for being with me. Barb, thank you for helping out in the chat there. Thank you to all of you. I'm going to end this conversation this morning with this comment that I used to make in a show that we used to call the Wall Street Wrap-Up, that I did with a couple of gentlemen, including Kevin Hinks from the Schwab Network, every Friday afternoon. And I would end the day and end the week by saying this: keep your arms and hands inside the ride at all times. Hang on and have fun. And I think that's maybe the best advice that I can give. But what that simply means is keep your arms and hands inside the ride at all times. Manage your risk. Hang on. Stick around. Make decisions that help you to stay in the market and be invested over a long period of time, and have fun. This should be a fun activity. This should be something that you enjoy doing, not something that is difficult or stressful for you to participate in. And if you find that it is stressful, perhaps think about learning more, managing your risk better, and becoming a more educated and informed investor in 2026. So, Brent, thanks for being with me. Thanks to all of our production staff and our great reviewers and our great compliance folks and everybody here at Charles Schwab. Have a happy new year to everyone, and we will see you on Friday in the new year. Take care, everybody. Bye-bye.